ICT works, and I don't mean it works sometimes or it works if you get lucky. I mean the framework itself is sound, but it only works under certain conditions. You have to stop trading everything. I'll explain what I mean in a second and take you through some charts that really showcase the algorithmic precision in these markets. Firstly, if you're new here, my name is Ali Khan. I'm a 9th year ICT charter, so if you're going to learn from someone outside of ICT, I can promise you that you're in the right place. And if you've been studying ICT for a while but still feel inconsistent or overwhelmed, this video is going to explain exactly why. This probably looks familiar. Liquidity, fair value gaps, order blocks, your macros, all the different models from the power of 3, silver bullet, 22 model. None of this is inherently wrong, but when everything is on your chart, all at the same time, decision making starts to break down. This is where most traders get stuck. ICT slowly turns into a menu. You pick what looks good, you trade what feels right, you change your mind mid-session, but markets don't reward menus, they reward models, fixed rules, repeatable behavior, and clear decision-making process. This is something that gets misunderstood a lot. ICT is not a strategy, it's a framework. It explains how price moves, why it moves, and when it's likely to move. But it doesn't tell you to trade everything it explains. That part is up to you. And the best way to do that is first by understanding narrative, then bias, then time, and only then do we look for an execution. It's the very last thing on the list, but many traders are first looking how to get into the market before understanding what the market narrative is all about. Now, essentially, ICT only really starts to make sense once you start introducing constraint into your trading. And this is how you should always start, is one narrative, one session, and one model. This is the part most traders just simply want to avoid because they think that having more models, more things to look at, will equal more trading, and therefore more trading equals more profits. And that is absolutely the wrong way to approach trading with ICT concepts. You want to put constraints because constraints feels essentially limiting, but in trading, constraint is what creates clarity. ICT works because markets are essentially algorithmic. Price is delivered on a script. It's programmed to seek liquidity, balance inefficiencies, and then reprice higher and lower. The algorithm is consistent and it's predictable. The problem is that most traders aren't. Let's take the power of 3 model, for example. It's very simple. We have accumulation, manipulation, and distribution. And this process repeats across all markets and timeframes. Your job is to align with it. Just because price drops below the opening price at 12 a.m. doesn't automatically mean that you buy it. And just because it runs above the opening price doesn't automatically mean that it's a short. Now, I want to show you something important. We're going to use the same model, same execution time frame, but 2 very different outcomes. And this is where most traders draw the wrong conclusion. So here we have the euro dollar on the 5-minute time frame. Now, clearly we have the 12 a.m. price delineated here, and this opening price is our 12 a.m. Eastern Standard Time opening price. Below the market here we can see our Asian low between the time of 8 p.m. and 12 a.m. Now, clearly we have our accumulation phase here. Post 12 a.m. we have our manipulation phase, and then we have our distribution phase higher. But what I want to do here is to take this piece of price action, and we're going to zoom in here a little bit so I can give you a little bit more teaching points here. Now here we can see that we have a dealing range form. After we raided this high, we have a new high, and then we raided the Asian low, forming a new low. This creates our new dealing range from high to low. Now once we have a dealing range, we can of course grade this dealing range with our DRT levels. We have our 100 level at the top, we have our 0 level at the bottom, the 50 DRT level, the mid price between the highest price and the lowest price, then in between those price points, the 75 and the 25 DRT levels. Now, watch what happens here. After we raid sell side below the Asian low, after price has dropped lower below the opening price, we then see this candle here close above the 25 DRT level. Now that's important because there's two things happening here. We're seeing the opening price of these two consecutive down close candles breached. This signifies a change in state of delivery after we have raided a sell side pool of liquidity. Also note, at that 25 DRT level, we have a buy side imbalance that overlaps with that DRT level. Look at all the candles here. See how they respect that 25 DRT level. When you see this, this is your indication to start entering positions. Price is being held here for smart money to accumulate longs. We then see the next candle print closing through the 50 DRT level. Again, this indicates that price is going to run higher. Price again runs higher, closes through the 75 DRT level. Now note what's happening here. It's creating a balanced price range. And then we run and close through our dealing range high. Now everything here works perfectly, and when you align narrative with the right model, look how precise this can get. I'm just going to zoom out over here. Now if we take the Asian range low and the Asian range high, and we project two deviations of that range higher, we get a price point of 117,382. I'm just going to zoom in here onto the actual high that comes in at 1.17382. That's a perfect delivery of price inside of that London session. Now, of course, this level of precision and the right models are all going to work when we have the correct narrative and understanding behind why price is going to reach for a certain level. Now, if we zoom out here and we go to the 4-hour higher time frame perspective, this blue arrow here is our lower time frame. So this is where we were dealing with our 5-minute chart. We can clearly see that price was going higher, but why? Because prior to this low, we had this buy side imbalance, and we had seen all of this price action at that discount low of the buy side imbalance, right? What was happening? None of the bodies were closing below that buy side imbalance. We also have this last down close candle before that impulsive move higher, leaving the buy side imbalance. And we're seeing how we're finding support here also. So when time here aligns with price, now we're anticipating higher prices to reach for the buy side above the market. This is when we look for the power of 3 to work, when we're buying below the opening price to go long. Now, here's the thing. This is another example, but this time it doesn't work, and I'll explain why. Here we have the opening price at 12 a.m. again on the euro dollar on a 5-minute time frame. Now price initially runs away and then drops lower into our buy side imbalance in this blue shaded area. We see that we hit the consequent encroachment here in the beginning of the London session, and then we have this impulsive move higher. Now obviously people start chasing price here. They've seen this gap close above the highs, and therefore when price returns to the gap, they're expecting higher prices. But in this case, so when we zoom out here and we get to the 4-hour time frame, now again, this blue dotted line delineates that lower time frame 5-minute chart. On this time frame, we can clearly see that we have a dealing range. We have the dealing range low, we have the dealing range high. Now notice where we are here. We're inside of a premium market, so we never want to buy inside of a premium market. Now, there obviously are conditions when we can do that, but as a general rule of thumb, we first don't want to buy inside of a premium market. The second thing here, what we can clearly see, is that all of this price action here is sat below this inversion fair value gap. And we have seen all the bodies here, look at that, failing to close above the consequent encroachment. Look how many times it's tried to get above it. Again, a strong indication that price here is bearish. And then we see the market displace lower. Now notice what we would be aiming for. In an extreme discount, we have this buy-side imbalance. So when the market is already in a premium below the market, we have a buy-side imbalance. That's essentially where it's going to reach for. Also note all of the reaction at the 25 DRT level. Look at this in the context of having the higher time frame inversion fair value gap above the market. We can see that after the opening price, when we raided the short-term low, price was just repricing into the inversion fair value gap. It did not have the legs to reach into its consequent encroachment, and then we see the market turn around and close below the opening price and below that swing low, that raided buy side. This is very, very crucial. Now this gives us context behind where the market is likely to turn to, obviously coming down from the higher time frame. Also note here, we have this buy side imbalance, and then right next to it, we have sell side delivery repricing back through that inefficient area of price. Now again, just for the sake of precision here, we can refine that balanced price range to this high up here because we've dug into some of that area already. So now the new balanced price range is going to be from this candle's low to this candle's high. Note how we run into that area here inside of the New York session, hitting that consequent encroachment. Now watch this. The actual price of the consequent encroachment comes in at 115,909. The actual high of this candle comes in at 115,909. And if we now take our Asian range from this high down to this low, and we project 4.5 standard deviations, we get a price point of 1.15117. Let me just move this out the way. And if I zoom in here and hover my cursor over the low down here, the closing price comes in at exactly 1.15117. Again, perfect delivery of price, but working only in conditions where we have the right narrative and context behind the trade in the first place. This is the key lesson here. The model didn't change, the narrative did. And this is why trading everything breaks ICT. Most traders think consistency comes from being right more often. It doesn't. Consistency comes from repetition, making the same decision under the same conditions over and over again. That only happens when you trade less, not more. So if you're still watching, still collecting, still hesitating, it's probably not because you don't understand ICT. It's because you haven't decided what kind of trader you are yet. This isn't a knowledge problem, it's a decision-making problem. And that comes down to understanding what the market is trying to do. Until you understand that ICT will always feel just out of reach. This is what mentorship is actually for. Not more strategies, not more concepts, but clarity and understanding, helping you choose a model and commit to it properly. If this is something that resonates, then click the link below this video and apply for my mentorship program. Take care, and I'll see you soon.